Milan. I will be doing question 1, which is analysis of transactions. I took this from DBE Grade 10 June Examination 2018. Now it reads as follows. Information we are dealing with Soccer Pillay. Well, Soccer Pillay is the owner of Soccer Supplies. So our business is Soccer Supplies. Keep that in mind, to keep it in mind, just to make sure that you highlight it. The business uses a markup of 25% on cost. I don't know if I'll need this, but I'll highlight it for now. We are required to analyze the transactions that occurred in April 2018 according to the answer book provided. The first transaction has been done for you. As an example, you need to assume that bank has a favorable balance at all time. So the first transaction was basically us paying for water and electricity using by EFT. And to enter it, you debit water and electricity, you credit bank. Amount will be 450, and the assets you'll have minus, and the owner's equity you'll have minus. The reason why we have minus under assets is because bank is going down, and we have minus under owner's equity. That is because water and electricity is an expense, and an expense will subtract or reduce your owner's equity. Remember, under owner's equity, you have 4 things that fall under owner's equity. It is capital, drawings, income, and expenses. I normally call it DICE, which is capital, which is drawings, income, capital, and expenses. DICE, D-I-C-E, drawings, income, capital, and expenses, where drawings and expenses will reduce your owner's equity. That's why we debit anything that is drawings or expenses. And we credit income and capital. That is because they increase owner's equity. And anything that increases owner's equity will increase owner's equity on the credit side. All right, let's get to the first question. The first question says that Soccer Supplies bought merchandise for cash, which is 10,000. 2 accounts affected there. What are they? It is bank and merchandise. It's another name for trading stock. We bought trading stock. Already they credited bank. Obviously, we need to debit trading stock. Both of these are assets. Because trading stock is going up, it's an asset. Bank is going down, it's an asset. Bank is going down because money is going out. And that will result in us having plus minus under owner's equity. The plus is for trading stock because we have more trading stock. The minus is for bank. That is because we now have less money in our bank account. Owner's equity and liabilities will be 0 because they're not affected. Let us move to the next one. On the 3rd, we sold goods on credit to B90 for 5,200. In that example, in that question, please note whenever we sell goods, 4 accounts are affected. If we sold it on credit, we debit debtors control, we credit sales. Sales is income. So income increases on the credit side. Debtors control, it's an asset, it increases on the debit side whenever customers owe us more. Both of those accounts will increase at selling price. Then the other 2 will be trading stock and cost of sales. Trading stock goes up whenever we, did I say trading stock? No. Cost of sales go up whenever we sell goods, and it goes up at cost price. So we debit cost of sales, we credit trading stock because we are losing trading stock. Those are the 4 accounts that will be affected. First one is debit debtors control, credit sales. The other 2 will be debit cost of sales, credit trading stock. Now, the problem is here we are given 5,200, and that 5,200 is the selling price. We don't have the cost price. We might have to calculate the cost price, but luckily we are given the markup, which is 25%. So how do we record that? You will first debit debtors control, because we are being owed more. Debtors control will increase on the debit side whenever we are owed more. We credit sales because it's income, and the assets you'll have plus, and the owner's equity will have plus because sales is income. It increases owner's equity. Now, the other one, we have to debit cost of sales whenever we sell. Okay, that is an expense. Trading stock will be credited. That is an asset because we sold stock, so we have less of stock. To calculate the cost price, you'll have to take the 5,200 multiplied by 100 divided by 125. If you don't understand what's going on there, please check out a video. It's just based on the calculation of markup, given cost price, calculating the cost price, given the markup, calculating the selling price, given the markup. I explained it thoroughly there. So hence here we'll calculate the cost price by multiplying by 100. The cost price, because the markup is on cost of sales, cost price will always be at 100. And this will give us 4,160. Give yourself 2 marks for that. Okay. And the assets will have minus because we lose in trading stock. Cost of sales is an expense. Expenses reduce owner's equity. That's why we have minus under owner's equity. Okay. Let's move on. Next question. It says that B. Naidu, it's the same guy that bought on the 3rd, returned damaged stock with a cost price of 2,400. Issued a credit note, meaning we issued a credit note to B. Naidu. We issue a credit note when the customer returns goods. Same as sales when we sell goods. This will result in 4 accounts being affected. We are going to debit debtors allowances, which is a reduction of sales. We are going to credit debtors control because we are being owed less. Both of those will be recorded at selling price. Then we're gonna debit trading stock because we are getting the stock back, and then credit your cost of sales because we are reducing what we have sold. Cost of sales will decrease, and it will decrease on the credit side. You will realize that this is the reversal of the previous transaction. Let's record it. The problem with this is that when we decide to debit debtors allowances, which is like a reduction of sales decrease on the debit side because it's income, will credit debtors control. Both of those must be recorded at selling price, and we were given the cost price. So you will simply take the cost price, which is 2,400, multiplied by 125 divided by 100. That'll give you the selling price of 3,000. And the assets you'll have minus, because debtors control is an asset, it's going down, and the owner's equity we have minus. Debtors allowances is a reduction of sales. Sales is income, therefore debtors allowances sort of is like an expense. So expenses will reduce owner's equity. As I've said, cost of sales will decrease on the credit side, but the debtor returned goods, we are going to debit our trading stock because we're getting more of that, and credit cost of sales. Okay, and the amount will have the 2,400, and the assets will have plus, and the owner's equity will have plus because we are reducing an expense, which is cost of sales. Under owner's equity, we will have 0. Okay, let's move on. As it say, next one. It says that on the 24th, before we get to the 24th, the 20th, B. Naidu settled his account in full, less 10% cash discount. Now, question is, how much is B. Naidu owing us? We have to calculate that. On the 3rd, he bought goods worth 5,200, and on the 10th, he returned goods, but we were given the cost price, and the selling price of those goods that were returned, we calculated it. It was 3,000. Remember, B. Naidu will owe us the selling price, not the cost price. And for us to determine the amount that he paid, we are going to take that 5,000. Actually, we are simply going to take 5,000 to subtract the 3,000. Whatever we are left with, first of all, I'm going to debit bank. The reason why I'm debiting bank, It is because he is paying us. And the fact that he's paying us, our bank account will increase, and it will increase on the debit side. How much is he paying us though? We only getting, basically he bought for 5,200. We're gonna minus what he returned. The selling price of the returns was 3,000. That will give us 2,200. Take that and multiply it by 90%. It'll give us the amount that he actually paid, because we gave him a discount of 10%, it means that we will only receive 90% of what he was owing us. And that will be 1,980. I know someone might say, yeah, but why this? You could have taken that 2,200, times it by 10%, get 220, and then take 2,200 minus 220. It was going to give you the same amount. Both of these are assets. Debtors control is decreasing because the debtor is owing us less. Bank is increasing because we are receiving money. Therefore, the plus will be for bank, the minus will be for debtors control. Under owner's equity, we have 0, and under liabilities will also have 0. It doesn't end there. This guy was owing us 2,200. So the other 220, which is the 10%, was a discount, and that will be an expense. That's why we debit discount out, and then we will credit debtors control. That is because he's owing us less, writing off the entire amount that he was still owing us, which was 2,200. And for me to get that 220, I took 2,200 times 10%, and that gave me 220. Discount allowed is an expense. It will reduce your owner's equity. Debtors control is an asset. It's decreasing. Therefore, it will decrease your assets. That's why we have minus under assets. We have minus under owner's equity. As I've said, discount allowed is an expense. It will reduce your owner's equity. Let's move on. On the 24th, we paid for stamp from petty cash, which is 45. So there we will simply debit stationery and credit petty cash. I don't know if anything has been entered for you, because this is postage stamps. That will be, they were not specific actually. So they debited postage, so that's why I'm assuming it's postage stamps. Otherwise, I was going to assume it's stationery. And we will credit petty cash because that's an asset. It was paid from petty cash. Assets will have minus, owner's equity will have minus because postage is an expense, and liabilities will be 0. Okay, let's read further. It says a fixed deposit of 18,000 at bank matured, and on this day we received the amount by direct deposit. The fact that the fixed deposit matured, people think the fixed deposit and your bank account is one and the same thing. Guys, that is totally wrong. Okay, fixed deposit, it's a fixed account. It's a non-current asset account. It increases when you put money into the, meaning when you increase your fixed deposit, you're going to take money out of your bank account. So your bank will decrease on the credit side, and then you put it into the fixed deposit, which is an asset as well. So fixed deposit will be debited. When they say it has matured, it means that your fixed deposit has reached its maturity. So if you invested that for 5 years, now it's the 5th year, you're getting your money back. So your fixed deposit will decrease, and it will decrease on the credit side. And then you're going to take that money, they're going to take that money and put it into your bank account, which is your savings account. And your bank will increase by that amount, which is 18,000 in this case. Therefore, we'll debit bank because money is coming into the account. We credit fixed deposit because it's going out of the fixed deposit. These are two different accounts, and most students treat them as though they are the same. Though they both fall under asset. The plus will be the money that was deposited into our bank account. The minus is the money that was taken out of the fixed deposit. Okay. And in this case, under liabilities will have 0, and under owner's equity will also have 0. All right, let's check the next one. It says that we charge DBE Smith interest at 12% per annum on his overdue account of 900 for 3 months. That was per annum. 12% was per annum. Highlight that because sometimes the interest will be per month. In that case, you will simply take the amount owing, times it by 12% and times it by 3. But here, because they said it's per annum, we are simply going to multiply by 3 and divide it by 12. Per annum means it's for 12 months. We are going to what? To take what he already owes us, which is that 900. And that is for 3 months. How do we calculate interest on that? You will take the 900 multiplied by, wow, I debited, obviously the accounts affected here will be, debtors control will increase on the debit side, or you can write the name of the debtor. Interest income will be credited because you're earning that income, and to calculate the amount, you will take the 900 multiplied by 12%, multiply by 3 over 12, which will give you 27. Debtors control is an asset, and the assets will have plus interest income. It's income that will increase owner's equity. That's why we have plus on the owner's equity, and under liabilities will have 0. All right, and that's how you will get those 45 marks. Okay. I took this from 2018 as well, so you can check it out and try it out and answer the questions there, and I will post the video later on. Okay, you need to prepare this. And answer the questions, okay, that were given to you, which is 2.1 and 2.2, as well as 2.3. And that will be it. And then thereafter, we will do question 3 in the same paper, which deals with cash receipts and cash payments. You can also try this out. Obviously, you'll have to prepare the cash receipts journal as well as the cash payments journal. Okay, you can download the question paper and just answer it so that when you watch the video, you will just mark. All right. That's it from me, Khozo.